everyone, and welcome to the first episode of the Spacing Out podcast. Today, I got to sit down with Rob Reed. Rob wears lots of different hats. He's a financial coach, a sales training coach, and also a business coach who works with insurance companies all across the nation. He's 20 years of experience within financial markets and is also the CEO and founder of CWR Private Client Group. I was super excited to be able to get a hold of him. He travels all over the place very frequently, so we were able to thankfully get a moment to sit down in his office in person and record this podcast. So I'm sorry if the audio is a little bit subpar than the standard we've been able to climb to, but I think the content here is so invaluable. We cover everything from past investment vehicles to tax advantaged strategies and real estate, and even the incoming retirement crisis and how to plan around that, or even just the historical nature of taxes or interest rates. So I think there's a lot to learn here. He's also really good at breaking these concepts down. This is what he does. He has so much experience in it. He teaches sales teams how to even talk to people about their finances and about that financial planning. We're really focused on lower range age groups, but we also made sure to talk about those retirement packages as well and that later in life planning that goes along with your finances. So I hope you enjoy the content. Please take a moment to also subscribe and like the video. Maybe leave a comment down below. It really helps the YouTube algorithm, and I appreciate your time, and I hope you enjoy the podcast. For people who have no clue what CWR is,
yes,
or like what you do for CWR, can you like maybe go over like a quick explanation?
Yeah. So in essence, we take everybody's financial situation and look at it very differently, and say where are you at right now, and then where are you going, and kind of put a plan together for that. Sometimes it's out of the box thinking, but we do a lot of financial forecasting, find some inefficiencies that most people have in their financial portfolio, and kind of look at those and pull some differences out and reassess.
Okay. Yeah. So when you're going over, when you're breaking down people's portfolios, are you know, there's a lot of products that you work with in particular that you kind of address for them, or are you doing like a overall, where was your money at, where can we put it, or?
Yeah, good question. So first, what I do is I look at where their money is going today.
Okay.
You know, one of the biggest things I tell clients is I think there's more value in finding the inefficiencies in our budgeting rather than trying to pick the winners.
Okay.
So if I can find $1,000 a month that you're losing unknowingly and unnecessarily outside of your wealth target, with zero risk, I think that's far better than trying to pick the winners out there.
Yeah.
So especially for some of the younger clients, is finding those inefficiencies they have within their current financial situation and helping them find those dollars that we can be investing in other options.
Yeah, that's great, because most of the time, especially with younger people, what they're trying to do is just chase as much gains as possible, probably not thinking about whether they're bleeding money or losing money, especially when it comes to taxes and stuff like that.
Right,
yeah.
Taxes. So one of the biggest, some of the big leaks in our wealth, our accumulation to wealth, are like how we pay for our mortgage, our qualified plans, which if you don't know what that is, that's any type of tax deferred type of an account that your money is held inside of. Taxes, college education, either for kids, grandkids, whatever that is, and then major capital purchases. So those are areas like major capital purchases. It could be buying a set of new tires. How are we finding that money? What are we using? Are we putting it on credit cards? Are we using cash? Anything that you can't buy for out of your monthly income is a major capital purchase.
Okay. Yeah.
So those are the 5 areas that I look at to kind of help find money that you're losing. Usually the age category ranges from your mid-20s all the way up until your 50s, that we're losing tons of our money that we could be investing in other things.
Okay. Yeah, so I mean, just especially with the audience that is at Nobel Trading, is a lot of a younger audience. Mm-hmm. So like, do you have maybe just a few pointers correlating to what you just went over that would maybe apply to people in their early 20s or maybe even approaching that, especially as like in college or?
Yeah, so if you're in your 20s and you're looking at accounts to invest in, I'm not looking at investments. I'm looking at the type of an account there is. So there's several different types of accounts. There's taxable accounts, which is like a brokerage account, where you're buying and selling different types of activities. And if you have some gains, right, and you sell, you're going to pay tax on those gains. That's a taxable account, right? It's always being taxed based on those realized gains that you have or losses. The second type of account is tax deferred. So tax deferred is saying, well, I get a tax credit on it. So most of these are IRAs, qualified plans, 401ks, those types of things. Mm-hmm. I get a deduction on my tax today, but then I have to pay taxes, or I'm postponing those taxes until later, right?
Right.
You're in your lowest income years that you'll ever be in your 20s. Hopefully you'll earn more money later on, right?
Right.
And when you become retired, when you start taking those monies out of those accounts, the tax bracket could be triple or quadruple what it is today. So those are one of the tax inefficiencies that I see. Also in the tax advantaged accounts. So these are accounts that might have some descriptions in the way of they could be tax deferred, but then you could possibly get those assets out tax free. So those are the three types of accounts that I look at and review for folks, and then say, which ones do you want? Well, majority of the time, most people want tax advantage. I want to pay tax on it today and never pay tax on it tomorrow, right?
Right.
Which is a Roth, right?
Right.
Most people are eligible. If they've got earned income, they could be eligible for a Roth.
Right.
That's a great option for that, right? But it's probably not the best option to go grab money when an opportunity exists, right?
Right.
So most of the young traders are Nobel. They're investing in the market. So if some opportunity came up out of that's outside of the market, where would you go get money? Would you sell all of your assets and then go move all that money into that outside investment, right?
Yeah, most likely that's what they'd have to do.
Right. So you'd have to lose the opportunity of the market going up even more. Right. To go hopefully make some money somewhere else. So these are some different like coaching kind of things that we go through with our younger clients and say, hey, what does that really look like? Or an emergency came up, right?
Right.
I need $10,000. I have to go sell a bunch of stock.
So what would you say would be the best alternative when you're talking about these tax advantage accounts?
Yep.
And then the Roth IRA maybe not being one of the best alternatives that they can take? What comes to your mind?
Yeah, great question. Yeah. So Roth options are great for that investment account that you want to keep in the market.
Yeah.
I always tell people the best time to buy a stock is when? Yesterday. Yeah. Right. The best time to sell a stock is never. Yeah. Right? Because you pay tax on it.
Exactly.
And that's what Elon Musk. You look at Elon Musk. What does he have? He has to sell stock options.
Yeah.
To have taxable income, right?
Right.
So, but he was like, I never want to sell it, so I'll never have taxes.
Yeah.
But he can leverage it. He can borrow against it, do whatever. So those are the types of things we look for. But sometimes you can only margin up to 50% of your account value.
Yeah.
And what happens if that account value falls? Margin call, right?
Right.
So those are the types of things that have a risk associated with that. So there's some other options that a lot of people do to collateralize against an asset without losing the opportunity cost of the upside of that account.
Okay.
Does that make sense?
Yeah. And I mean, I would even like to dive into that a little bit deeper, especially into the life insurance products, which I think most people are completely unaware of.
Yeah.
And of course, I'm asking this with already some background knowledge on it. But I guess before we kind of segue into that part of the conversation, I guess the big question would be like, what is the best way to address people who their immediate reaction to even hearing about life insurance is like, this is a scam, this is nonsensical.
Right.
Well, what would be your way of addressing those concerns?
Yeah. So it's funny. So I get a lot of that. Life insurance is a scam, or Dave Ramsey or Sue Zorman said no, don't invest in that. Right.
Right.
So most people don't invest in things that they don't really understand.
Yeah.
That's where I get most of the backlash from, when people don't understand how a life insurance contract works.
Right.
Okay. They don't understand the inner workings of it. Why should I have it? They look at it just for the bubble as the life insurance piece, and not the benefits that accumulate inside of the account. Okay. And most of the times we're talking, most people that invest in these type of contracts have some money, are more sophisticated, need to have an account that's leverageable, or they can collateralize at any given time without having to go to a bank or ask permission for that.
Right.
So that's kind of the basis behind it. Most people are scared of it because they don't understand it. They've been told not to buy it, and been told it's a scam by their Uncle Larry or Joe, who is like a carpenter. Nothing against carpenters, it's just they don't have any financial, education or well-being or knowledge outside of what the people are telling them to do.
Yeah.
Right? The basic people.
Yeah,
right?
Exactly.
So does that kind of cover that?
Yeah. And I would even and they're gonna, when it comes to knowing the different products that exist within life insurance, I think even you would agree that some of them are just like, they're not. When it comes to maybe like whole life, so like can you maybe break down the difference between, let's say, like a whole life product or maybe like an index based life insurance product, which is I believe to be the product that you're kind of getting people to realize the utility of.
Right. Yeah. So it's funny. So there's permanent life insurance contracts. We call them PLIs. Yeah. They consist of both whole life and indexed universal life. So, but there's two different facets that those contracts come into fruition with, right?
Right.
So a whole life contract is fixed, right?
Right.
That has no flexibility. So if you have $15,000 a year that you want to invest into a whole life contract, great. You have to pay that $15,000 every year that the contract says you're going to pay it. Okay? It has a fixed interest rate that's inside of it based on usually bonds, those types of things. Usually a smaller interest rate, but it's usually guaranteed.
Okay.
Whatever the illustration says, that's what it's going to be. Most whole life contracts also get a dividend from the company. So the company will invest those insurance premium dollars, and if they get a better, higher return than anticipated, they will give a dividend back to those participating whole life contract owners. Okay. Not guaranteed. Most companies that have been paying those for the last 80 years will probably continue to pay them, right?
Right.
But it's fixed, right? You can't increase or decrease the death benefit. You can't increase or decrease the premium. It's a set amount, right?
Right.
So I do have some clients that I do that for. Usually they're older clients in their 60s, and I know exactly where the money is coming from.
Okay.
To fund those.
Yeah.
Right? I have an asset that I'm turning over into a tax-free asset, and I'm shifting those funds over annually.
Yeah.
Right?
Right.
I know it's there, it's guaranteed to be there, it's going to be there forever, right? Flipping over to an indexed universal life contract, what we look at is the flexibility of it. So if you got that same $15,000 to invest this year, well, what if you're a business owner, right?
Right.
Your income goes up and down all the time. Fluctuations, right?
Right.
And then maybe next year you don't have 15,000. Maybe you get 10. You can do that. It's flexible.
Yeah.
Right?
Okay.
So how I do that is based on your age, time horizon, assets, where we're getting the assets from. Those are the differentiating factors on the IUL. The IUL, the Indexed Universal Life Contract, what it does is say we've got an index that we're picking. You put $15,000 into it. There's some costs associated with the contract, death benefit, fees, admin fees.
Yeah.
Same you would see on a regular investment, higher in the first years than in the later years, right? But what happens is it's up against an index. So you put that $15,000 in there and say $12,000 goes to work for you right away.
Yeah.
We're going to match that up against an S&P 500 index and say, hey, you know what, Josh? So if that index does 10% this year, we're going to give you 9.5% of those earnings. And we'll credit your account with that 9.5%. In the following year, if the market goes down by 25%, you get 1%. you're guaranteed 1% in that account no matter what. That's the floor, as they call it, right?
Yeah.
And the top is usually about 9.5% to 10.5%, depending on what kind of index we put it in there. It's capped, right?
Okay. Yeah.
This isn't so I compare a risk tank and a safe tank. This doesn't go in your risk tank. This is not going to lose assets. It's not an option or a stock or an ETF or anything like that, right? It's not anything it's not going to get the high return over here, right?
Right.
Anything with a high return can also do what? A low return or a negative return, right?
Yeah, right.
This is in our safe tank. We know we're not going to lose our principal, but we're not going to have extraordinary gains in this account.
Yeah.
Right? We might see in our safe tank maybe gains of between 3 and 7%. Right?
Right.
Depending on what's in there. And that's pretty good for having zero risk.
Yeah.
Right?
Right.
That's our safe tank. Zero risk. But the thing is, which tank would you take money out of if you needed money? Would you take it out of the risk tank or the safe tank?
I would probably take it out. Personally, I would take it out of the risk tank. Yeah.
Right.
Right.
But guess what you lose? Guess what you lose, right? Opportunity cost. So that's where the life insurance fits in that no one really knows about, is you can collateralize against that asset on the life insurance by not touching that account. So if you've got $100,000 in there and all of a sudden a real estate property comes up and you need $75,000 today, tomorrow, let's say tomorrow, right?
Yeah.
So you need $75,000 tomorrow. You can sell $75,000 of your stocks, right?
Right.
But then what if the market goes up, like doubles over the next month?
Yeah.
What happens?
You've had all that opportunity loss.
Yeah. You're draining the tank.
Right.
And then you have to build that tank back up. We're over on the life insurance side that's in the safe tank. You collateralize it. You don't actually take the money out. You go to the life insurance company and say, hey, I have $100,000 in there. I need $75,000 today. Can you loan it to me? They'll be like, great. We're going to pay you the same interest rate that you're making in the account. So it's a net zero.
Yeah.
And guess what? You can pick whenever you want to pay it back. Go ahead. No big deal.
Yeah. Which is,
you want to pay it interest only? That's fine.
Yeah.
You never want to pay it back? That's fine too. I don't care.
And the interest would be zero. So
the interest there's an interest rate. Say if the account is earning 6%,
okay,
the interest rate from the insurance company would be 6%.
Okay.
Right?
Yes.
So you could just pay interest while this is still accumulating, right?
Right.
So there's a difference between simple interest and compounding interest, right?
Right. Exactly.
Loans are simple interest. Investments are usually compounding interest.
Yes.
So there's a difference there. Even though I'm borrowing it for a 0% net, I'm still making more on the compounding interest than I'm losing on the simple interest side of things.
Okay, yeah. Okay, yeah.
So that's how that permanent life insurance account works, where you can use that asset, collateralize against it, right?
Right.
And then you can use it to go buy that property, right? And then you can slowly take investment income from that property and put it back into your account again, so it becomes leverageable again later on.
Yeah.
So you're not paying yourself back. I hate that kind of term. You're kind of just funding your account again, so you have access to it again multiple times.
Yeah.
Okay.
That's excellent.
Yeah.
Yeah.
So that's what those permanent life insurance contracts work on that side. For most of the younger audience that we have here, probably an indexed universal life would be the optimal way to do it.
More flexibility.
Yeah.
Yeah. Because their income's going to be bouncing up and down as
exactly
they're aging and stuff. Yeah.
Yep.
Okay.
But in your 30s, you're going to need something, right?
Right.
Right. So you want to go to a credit card, or do you want to take it out of your investment account?
Yeah.
Or go to the permanent life insurance contract.
So what would you do? You have a figure for how much they want to be making before they consider an avenue like this? Like if someone's in college and they have a part-time job, or maybe they're just starting in an entry-level position after doing an internship, and they're maybe only making the $30,000 to $40,000, or maybe just a little bit more than that.
Right.
Do you think it's a good time for them to start considering that?
Yeah.
Even then? Okay.
Yeah. So whatever dollar that you make right now, if it's a part-time gig and you're going to school, you should be saving at a minimum 20% of that dollar.
Right.
20 cents of every dollar you should be saving or investing, right?
Right.
So there's two things. I talked about that safe tank and the risk tank, right?
Right.
Most people, when they're younger, they'll go right after this risk tank.
Yes.
Right?
You get more time. It's also advised that they be a little more risky when they're younger.
Right.
Yeah.
But guess what happens, right? When the car breaks down.
Yeah.
They drain the tank.
Yep.
So what I would go first is I would build up your safe tank first.
Okay. Yeah.
Right?
Right.
Build up your safe tank accessibility to assets that aren't going to lose you money first.
Yeah.
And that's not even a permanent life insurance contract. That's just a savings account.
Yeah.
Right? You're going to lose money in the interest, but guess what? It's better than paying 25%.
Right.
Right?
Yeah.
Now you can also leverage a credit card, but as long as you can pay it back, but we don't know the future. That's leveraging against future income rather than collateralizing an asset. Right?
Yeah.
So that's where I would go
difference.
first is have that bulk savings, usually about 3 months of expenses. Not 3 months of your salary, 3 months of expenses.
Yeah.
So if you've got your rent, you've got electric bills, everything just to stay alive, 3 months.
Yeah.
And that's what you should have in an accessible, safe money tank, right?
Right.
And that's, depending on where you're at, it could be a low number.
Mm.
Anything above that, right, goes into your permanent life insurance contract or into investing, right?
Right. And so
you split that half and half probably.
Yeah, and so when they're making payments on that universal life contract, they can just use whatever excess capital that they have for that after they've taken care of their expenses.
Yep.
Is it so it's just whatever they can afford, and then the value of the contract will adjust to what they put in?
No, so it's not whatever they can afford.
Okay.
It's, remember, you have to pay yourself first.
Right.
Right?
Yeah.
So that's the thing. So I've got it on the wall over there, what Warren Buffett. Do not save what is left after spending, but spend what is left after saving.
Yeah.
20% should be your minimum, 80% spendable.
Okay.
Now, if you're living at home and your expenses are so tiny, then it should be flipped.
Yeah. Okay.
Invest and save 80%, spend 20%.
Yeah.
Right?
Right.
Because then when you go out to the real world, you're going to be like, well, I'm already saving $1,000, $1,500 a month.
Yeah. Yeah. I think that's just to interject, I think it's a huge thing that a lot of the younger audience that I talk to, they don't appreciate is the peace of mind and even confidence that it can give you to have like a little nest egg that you're sitting on. The amount of stress that it alleviates is substantial. So yeah, it is. Can't be emphasized enough.
No, and I think that's where a lot of even those people that are in their 30s and 40s, I see a lot of folks that have credit card debt. They have good jobs, making $170,000 a year, but they've got $40,000 in credit card debt.
Yeah, and I mean that's a great point, because what would be your advice for maybe someone who's like listening to this and they're like, oh, that's really cool. I'd really like to start saving better. I'd like to start considering these things, but then they look and they got student loan debt and credit card debt. As someone who's watching carefully when it comes to the consumer stats,
right.
A large part of America is sitting on no savings. They're spending a lot, and interest rates are expected to go up. We might hit some economic turmoil, especially with people out of their jobs, and needing to start pinching pennies more. How would you go about addressing, do you focus on paying off the debt? Do you focus on building up your savings and have a different strategy for the debt? How would you break that down for someone?
I would do both.
You would do both. Yeah.
So remember, we have to figure out why you got into debt first, right?
Right.
So this is where I relate right back to Dave Ramsey. Even though I don't like him as a financial guy,
yeah,
consumer debt is horrible if it's for lifestyle, right? If your debt is due to wanting the newest pair of shoes, wanting the newest car, wanting the newest everything, that's consumer, that's bad debt, right?
Right.
You need to rein in your spending first,
yeah,
right? Before doing anything else,
yeah,
right? Because that's just dumb.
Right.
If you're buying something that costs you money without something that makes you money, it's probably backwards thinking.
Yeah.
And that's where people get in, that's where America as a whole gets into trouble, is we want to look better financially than how we are.
Yeah.
Right? Debt is not bad. Debt due to buying the newest pair of shoes, buying the newest car, going out to dinner all the time. That's just dumb.
Yeah.
Right?
Right.
If you're using a credit card just to go to dinner because you don't have any cash in your account, that's your first problem.
Yeah.
Right?
Right.
Depending on how that looks. Mm-hmm. Now, on two sides of it, now if you were starting your own business and you went to dinner because you were meeting with a client,
yeah,
and you had to use a credit card, that's fine because you're broke.
Right.
Or you're trying to build up a business, right?
Right.
That's called investing. That's what I look at it as. That's marketing dollars.
Yeah.
But if you have a W-2 job and you're in consumer debt because you want to be look fancy for all the people that are at your job site, that's just dumb.
Yeah.
Right? So you have to rein that part in first. You have to figure out where that's at. Student loan debt. If you've got student loan debt, look at the interest rate. Go refinance it for the longest term possible. And just say, hey, that's my payment to make the money I make today. Because I got an education, I got training for that, right?
Right.
But you better darn make good money in that new job.
Yeah.
To afford that payment. A car payment. My philosophy is you should not buy a car that's more than 10% of your income.
Probably, yeah, it's probably pretty well advised.
Right? So if you're making $100,000, you should be buying a $50,000 car.
Yeah.
You should buy a $10,000 car.
Yeah.
Same with a house.
There's a lot of people who do not want to hear that.
Well, no, because they want the new car, right?
Right. Yeah.
You know, it's funny. More people, the majority of wealth in today's society is lost by buying cars.
Oh, wow.
You'll lose more money in just buying cars than you'll ever earn in any retirement account.
That's a wild statistic.
Yeah, it's the opportunity cost associated with it.
Yeah.
You're young right now, you've got a $500 a month car payment. Just do the time value of money, right?
Right.
How much is that $500 going to cost you at 65, 40 years from today?
Yep. How
much? Millions of dollars.
Yep.
Yet you wanted it for the car. And if you do that $500 every month, and it keeps growing until 65, millions of dollars gone.
Yeah.
Gone. Just from having the nicest car.
Yeah, and I don't think people consider that at all. Because it's so hard to it's so hard to visualize how that compounding effect would take a hold had the money not been split in this depreciated asset, but rather than building upon itself and whatever portfolio or investment vehicle. That's a definitely a tough one to even. Like when you're trying to get people to come to the realization of that, and I'm assuming there's like different tools you would use or calculations that you could show them and go over. Yeah, so
would show them how much money they're losing.
Yeah, okay, and like break that down for them. Yep. Yeah, that's probably a big eye opener for a lot of people. So when it comes to we talked about taxes and how and wanting that tax advantage account. What would you just say to someone who's like, I don't need to worry about that because I think in the long term taxes will overall go down. They're expecting maybe another some sort of I won't try to name specific names, but some sort of political candidate that it's going to come up. Oh, and then so taxes will come down. I don't need to worry about it. I'd rather pay taxes later. Or they just want to leave it up to the ambiguous hope that maybe they'll come down.
Yeah. So taxes are a big subject I talk about.
Yeah.
Taxes are actually on sale right now. These are the lowest taxes that have ever been since the temporary income tax was put in place in 1913. Lowest it's ever been. Right?
Right.
Now the two things, there's two ways to look at taxes. There's a tax bracket and there's the tax calculation. Right? The tax bracket goes all over the place, right? But how they calculate the tax is completely different. It's the income side of it. So back in 1944, I think it was, Ronald Reagan, remember him? Big actor, president, everything like that. 1944, the top tax rate was, guess what percentage? 92%. Right?
Yeah.
for everybody making over $200,000 in 1944.
That's wild
right?
to even think about.
So, what did Ronald Reagan say? He was like, "Well, I produce about 2 movies a year. That's how much I would. That's what I would get contracts for. So I'd make about $100,000 per movie." And he was always asked, "Well, why aren't you doing a third one? Because you have some time." He's like, "Well, if I did that third one, I'm only keeping about 8 cents on the dollar." Right? Because I'm on the tax bracket.
Yeah.
Everybody thinks that's the top tax bracket. The top tax bracket today is 37% for people making over $630,000. Right?
Right.
But guess what? They can change that any time. 1941, it was 88% for people making over $5 million. The following year, it was 88% everybody making over $200,000. One change. That's it.
Yeah.
In the wider cast of a net. In taxes, we have to look at we're in $30 trillion of debt right now.
Yeah.
And we came and balanced the budget. We're $3 trillion over it every single year, right? Just under spending.
Yeah. It's accelerating.
70% of our tax dollars go to fund Social Security, Medicare, Medicaid. Social type of things that are happening. The rest of it goes for military and everything else, right?
Right.
Once our interest on debt, that's a big one that's included in that. Interest on our debt is included in that 70% as well, right? So once our debt reaches about $43 trillion, guess how much interest on debt that we'll be paying? 100% of how much of income taxes we'll be bringing in. So what happens when you're paying more in interest than you are in services that you're getting? It's called default,
yeah.
Right?
Right.
So if you think taxes are going to go down in the future, you are wrong.
Yeah.
That's just my opinion.
Yeah.
Taxes are going to have to go up greatly. I predict that they're going to have to go back up to what they were in 1950 and 1960, which were easily double and triple what they are today.
Yeah.
And that's not for the people making over $400,000. That's for everybody.
Yeah.
That's for everybody.
Yeah.
You're gonna, at minimum, because we've never paid back for any of the wars we had back in the 50s. They paid back all. That's why the rates were so high in the late 40s and 50s. They had to pay the war back, right?
Right.
But everybody had savings. Everybody has money. No one has savings today or has money. We just all have debt.
Yeah. Yeah. And in the Discord, in one of the educational sections, I try to cover the macroeconomics and having to leave the gold standard to even pay for those wars and the ripple effects of that, but even why people had a bunch of money then, that's a lot of the boomers, and that's those glory days, that's the American dream right there.
Right.
Is you could come here and you could build up, and there's tons of jobs. Everyone's got savings. One parent in the household working, and now fast forwarding today, leaving the gold standard and all that money printing, not paying for the wars, and then you also mentioned the retirement, and I think this is a really important thing for people to kind of consider and think about, is this incoming retirement crisis that we could be walking into. And I know, do you have any comments on that, or is there anything that you're going over with clients to kind of bring that up as well?
So it's a huge thing right now. So the majority of my clients are in that 50 plus sector that they're preparing for retirement. So I call it the red area, the danger zone, 5 years before retirement, 10 years immediately following retirement. Because of the market risk and running out of money. Those are the big things. The biggest risk that everybody has is an inflation risk, which keys right to longevity, running out of your money before you die.
Yeah.
Right?
Right.
Back in, what was it? Well, even back when they initiated the Social Security and Medicare and all that back in 1935, the average life expectancy was 65, and you can turn on Social Security at 62. It was practically an insurance policy for living too long.
Okay.
But now people are living into their 80s, and Social Security hasn't changed.
Yeah.
Right?
Right.
So Social Security is one of those things that we're going to be paying for, but we're never going to see the benefit of.
Yeah.
Or we could be paying 3 times the amount that we're paying today and receive half of the benefit that we can expect.
And is that also at play because of this deflationary population of the younger generations not being able to afford to pay for these larger, older generations?
Yeah, well, so many years of retirement.
Yeah.
People used to not retire back in the day. There would be no retirement. They would get Social Security because they didn't work as much.
Yeah.
But the whole idea of retiring was not a big thing back then. People worked until they died.
Yeah.
Today, everybody wants to work for like 10 years and retire for 70.
Yeah, that's definitely true.
Well, you can have. Well, the thing is, there should not be a such thing as a retirement. I mean, literally, we should have Social Security kick in like 75.
Just as a health precaution.
Yeah.
Yeah. Okay.
Well, not the health of the economy.
Oh, okay.
Right?
Yeah.
Because we can't afford to keep paying these people.
Yeah.
I mean, people are paying money into the Social Security. That's why, like, for every 2 people, it funds 1 retirement, a Social Security person. That's going to go away, where it's going to be like, oh, we're in trouble now.
Yeah.
For every half person, we have to support 2 people.
Yeah.
Right? And so the costs are just going to go inevitably higher. So we've never pushed that Social Security retirement date off. We've always said it's a maximum retirement age. But it really should be, I mean, if people are living till 84, Social Security should kick in at 80.
Yeah.
For those people that didn't save well, they should still be working till 80.
Yeah.
I've got clients that have tons of money, $1 million+. They're at 74, they're still working.
Yeah.
I've got doctors who are working at 83 years old. He doesn't need the money whatsoever.
Yeah.
Right?
Right.
But he's like, why should once I stop, I die?
Yeah.
So to have a retirement plan is almost crazy in today's society with our younger generation. That's why it's almost, I look at 401ks and IRAs and all those items, they're obsolete in today's world. You need access to cash to start a business, to go out on your own, to be an entrepreneur, those types of things.
Yeah. Side hustles and...
Yeah. That's right. And if you're doing a side hustle, you should be saving 100% of that.
Right.
100%.
100%. Okay.
You shouldn't add that into your lifestyle. Right?
Okay, yeah.
100%.
Yeah.
It's not even there. It's just extra money to start my next business, to do something else, right?
Yeah.
So, go ahead.
Yeah. Sorry, but this is off the top of the head, but something that just came to my mind. You see this this common advice for young people to move to cities for the greater economic activity and stuff, and you see this counterplay of if you move out to New York, suddenly your salary is barely increasing in trade-off for these massive life expenses, but you could get these side hustles, and those side hustles are just helping you to just barely get by.
Right.
Whereas if you're living in somewhere like a suburbia area, you might have more opportunities across the board and a level playing field. Is this something that you ever consider when you're talking to people and talking about their money, especially since a lot might have a lot of real estate? I imagine these doctors have real estate all over the place. And is this ever something that you consider? Or?
Well, it's funny because you bring that up. So my brothers all live on the West Coast.
Yeah.
Right?
That's right.
So they all live in very high real estate markets. The real estate has gone up. I was just talking to my older brother about this. He lives in Seattle. His house is valued a lot, about $750,000, $800,000.
Yeah.
And I told him, you can come out here to the St. Louis area and buy a house cash for $250,000 and live in the same style house you live there.
Yeah.
And you can make about the same amount of money here.
Yeah.
That you're making out there. So the lifestyle is completely different, right?
Right.
So I would not pay for a intercity or a city type of a costs. So I was just out in Florida talking with a guy that lives up in New York in Brooklyn. There's a 6% tax in New York on your income for the New York City.
So crazy.
Even if you live someplace else, if you work or live in the city, you pay 6% income tax for the city. Then you have to pay state, and then you have to pay federal. Plus, I mean, how much does it cost? How much does real estate cost down there? A ton.
Yeah.
Right? $1 million to get a place. You got paid for car. If you want a car, that's $5,000 a year in insurance.
Yeah.
So if you just took all of that you would get just based on being around people, and took that further out to the countryside, suburbia,
Yeah.
and reduced your net expenses by 50%, what could you do with 50%? Even if you reduced your income by 25%,
Yeah.
what could you do with that 25% or that 33%, right?
Right.
Invest it.
Yeah.
All of a sudden you just reduced your outflow, right?
Right.
With zero risk. And then even if you put it into, like what we mentioned before, is that permanent life insurance contract, that is a little bit of gains, maybe 3 to 5%. We just took zero risk money that we just found, and now we're making 3 to 5% off of it.
Yeah.
With zero risk.
Yeah.
What does that look like 30 years from today?
Yeah.
So these are all these things that go off in my head when I'm talking to clients. I'm trying to coach them or consult them through even their daily expenses that they have going on.
Yeah. Have you had anyone, has it come up with, inflation's clocking in at like a 6% year over year right now. Now that's anticipated to come down. Obviously, it doesn't seem reasonable to assume that will be just some sort of permanent effect.
Yeah. So let me ask you the question, what inflation number are you using?
Exactly. Well,
whose inflation number are you using? Right?
Yeah, that's a whole different, that's a lot to unpack. But yeah, right, exactly. That's also the big part to play. If we do see the interest rates hike up in reaction to that, does that also then affect the amount that is being made on these permanent whole life? Do they adjust with those rate adjustments?
So the one biggest thing is they are inflation protected as they're inside of an indexed universal life. It is with the market, right?
Right. With that's what the universal index base, right? Does the permanent life have that same effect built into it or feature built into it?
The whole life?
Whole life, yeah.
The whole life has interest rates in there, right? Of what it's gaining based on kind of the bond market.
Okay.
But it's also getting the dividends on there, right?
Okay, yeah.
It's all about compounding.
Okay, yeah, that's right. That's the compounding.
Even if you're making 3% rate of return, the compounding side of it is a lot better than earning a 2% simple or a 4% simple. Right?
Okay, right.
So with inflation, those products do keep up with inflation, right?
Yeah.
Baseline inflation, when you look at inflation as a whole, I would consider inflation to be about 7 to 8% per year.
Okay, yeah.
If you look at everything, right? College expenses, housing costs, all the big items, right?
Yeah.
Right?
Right.
I mean, the regular inflation that the government tells us at 3%, it's been manipulated, right?
Yeah.
They're only looking at certain factors.
Yeah, and they adjust it all the time too to try and cut stuff out, try to get that number down. So
true.
For political reasons. So that's definitely something to consider. But I do know I just wanted to touch on that because it's people are so scared of that.
Right.
And moving away from even the life insurance, I think we've touched on that pretty well. Or when it comes to, or maybe we could even just talk about for a moment, when it comes to using that money within those life insurance contracts for different investment opportunities. Do you have a few examples of what kind of opportunities can someone who's using this investment vehicle kind of look for to use that money? That would be considered wise.
Yeah, so I look at that as I call that spike the ball. Okay. Right? How can I use that 3 to 5% interest account to take that money and go spike the ball with something, right? Right. So a lot of real estate investors use those accounts to get access to cash. They'll go borrow from the bank, 75% of the asset, because they can get a loan of that, but they might need the other 25% as a down payment. Yeah. But they don't want to take money out of an account and stop the compounding interest of that to go invest in this, right? Right. But if I get both winners from both sides, well, I need to get 25% out of there. Maybe it's $50,000. Yeah. Take $50,000 out of there. Go put it into that investment property. Maybe it's a flip. Maybe it's a fourplex, whatever it is, right? Right. Go put it in there. I might have to do some updates to it. So say it's a flip, right? Invest a real estate kind of a play. It's a flip. So I put buy it for $200,000. I put $25,000 into it. I get it reappraised 6 months later, right?
Right.
And then guess what? It values for $250 or $300, whatever, right?
Right.
Refinance it, take the cash out, put the $25 back into my account.
Yeah.
Right?
Right.
So I never stop that money by accruing, and I never will. Right?
Yeah. Right.
But I just made whatever on here with that money because I had access to capital.
Yeah.
Right?
Right.
So you can do that. You can do any other investment play, right? So say, it's hard on the stock market side because you can also lose money.
Yeah.
Then you're like, ooh, that stinks.
Yeah, there's a lot
right?
of risk to take on.
Right.
Yeah.
So I do it in a place where you're like, okay, this is the plan. I'm going to do real estate out of it. I'm going to go invest into a business. Maybe I don't. And that's the nice thing. If you're starting a new business, instead of draining your tank like you would in a 401k, people do that. They take their full 401k that has $100,000 in there and they're like, I'm going to go start a business. And they draft it all out, right? Well, what happens? They have to pay income tax
penalty
and the 10% penalty.
Yeah.
So 50% of it's gone.
Yeah.
Right?
Right.
That's why it's not a good account to have access to. Permanent life insurance you can have access to and then go invest it somewhere else.
Yeah.
A business, maybe you're starting a business. Maybe you can't afford to have payments back to there. Right?
Yeah.
Right away. You pick your structure.
Yeah.
But you can do a multitude of things that take capital to do that.
Right.
Right?
Yeah.
You're just building up your account reserve, which takes sometimes a little bit of time to mature over time, just like a 401k. It takes a few years to build up.
Yeah.
Right.
Oh, I mean, we just any
any asset.
Yeah, and then it becomes exponential as it grows. It becomes easier to grow, grows quicker.
Yeah.
Yeah. So when it comes to would you have any clarifying comments when people are looking like, okay, this is interesting. Let's say I've built up my life insurance. I have a good, I can borrow $50,000 out and use it. And I'm kind of looking at the real estate market, and maybe I'm considering timing it, or I'm considering a duplex over a single family home, or or even just looking at maybe a vacation property for like an Airbnb opportunity. Would you weight any of these as a better investment than another one, or is it something you consider? Is it just there's too many variables to really even call it, or
So there's usually like three things I look at when it comes to an investment, right? It's the risk is the first part.
Right.
Can I lose all of it?
Yeah.
Most times you can. You can lose a lot sometimes.
Yeah.
So that's the first thing, is assess risk. How risky do you want to be with it? And then with real estate, with properties, I look at cash flow. How much is this going to cost me on a liability every month to my bottom line?
Yeah.
Right?
Right.
And then if it does, how much do I have to rent it out? Like, so let's say Airbnb, right? You go put down, it's a $500,000 property, you need 10% down, bam, put $50,000 in there. But I know I can rent it out for, $500 a night. How many nights do I need to rent that for to break even? Right?
Right.
So maybe my costs are, and you have to look at cost as your mortgage payment, your insurance, your taxes, your upkeep, your utilities, all that comes out to $4,500 a month.
Yeah.
We'll have to rent it out for 9 nights every month to break even.
It's a third of every month.
Which is fine.
Yeah.
Right? But then you start looking, you do your research, look in the area to say, hey, other Airbnbs, I look at their calendar. If I want to reserve something, I look at their calendar. And I say, how many months are they booked up? When's their next full week? Full week, not just like 2 or 3 days, but full week of opportunity. If it's next week, or if it's 2 weeks from today and everything's clear, might not be a good area. Or the structure of the home might not be good, right?
Right.
So there's different things on there, but it all comes down to cash flow. And I've heard this from other people. This isn't new to. This isn't me talking.
Yeah.
This is just knowledge I've captured from other folks.
Yeah.
On a single family home.
Yeah.
If you buy it for $150, you should be able to rent it out for the 1% rule. I think Grant Cardone has that rule, 1%. 1% of the purchase price, monthly rent, right? That's profitable, right? I like duplexes, fourplexes, those types of things.
Yeah.
Because especially if you're younger, maybe just kind of building up, you can buy a fourplex, live in one of them, right?
Right.
Rent the other 3 out and make probably a third back, right? Of the total rents.
Yeah.
And if one person moves out, you're still covering the mortgage just with the 2 renters. So you're living rent free.
Yeah.
But you're not, because you're renting from yourself. You're just investing that part of it to build your nest egg back up again.
Yeah.
Never rent for free. You're always saving money, right?
Right.
It's an expense. It costs money to live indoors.
Yeah.
Right?
Yes.
Wherever you're at.
Yes.
Right?
Right. Yeah.
So that's the basis behind that. But there's all kinds of different real estate plays that you can do with that. You just have to look at the foundational pieces of it.
And I mean, when it so let's say that different scenario, stepping away from like the investment side. Let's say new home sales have been appreciating. The market's been really wild, but when you go through the statistics, like my age group, millennials, actually aren't buying very many homes. They're struggling to be able to afford a home. When they're weighing the risk and reward of the appreciation of prices and the different, the inability to even maybe get a loan done because a lot of these houses are going for cash and stuff.
Right.
What are some downsides to having a home and looking at it as like because I think the standard way people think about it is, I'm going to buy this house, it's the best thing I can buy, I need to own a home and I need to pay it off as soon as possible. What would be the other side of the coin when having that conversation?
Yeah. So let's talk about that. So when you own a house, that's the American dream that people talk about, right?
Right.
I don't think it is.
Yeah. Yeah.
You're not in control.
Exactly.
Right?
Yeah. Okay.
What if you lose your job and you have to move somewhere else?
Yeah.
And the housing market sucks.
Mm-hmm.
Or you moved in 2008.
Yeah.
And you had to sell it and you were underwater.
Yes.
Because you had a job opportunity somewhere else. What happened to those folks?
Yeah.
So owning a house in the wrong time is a horrible decision, right?
Right.
So you have to look at several different items when you look at owning or renting. Owning your house, remember, that asset, I leverage it, right?
Right.
The equity is doing nothing for you.
Mm-hmm.
Everybody's sitting around right now with equity in their house. And they're like adding that to their balance sheet, right?
Yeah. Right.
And I'm like, no, because that equity is earning 0%.
Yeah.
It's non-working. Would you ever hire an employee that's not going to work?
No.
No, well, that's what people are doing with their house, right?
Yeah, pretty much. It's funny.
Right?
Okay, yeah.
Because they're paying to maintain it,
Mm-hmm.
right? So the other part of home ownership is, guess what? You got to pay the mortgage, you got to pay the insurance, you got to pay the taxes, and guess what? When the toilet clogs at night, who's fixing it?
Yeah.
Yeah, and who's paying for it?
Mm-hmm.
When the AC and the furnace goes out, $5,000, $8,000, who's paying for it?
Yeah.
When whatever happens, right?
Right.
Updates, whatever, you have to pay for that, right?
Right.
If you're renting, who does that? Someone else.
Mm-hmm.
You're just prepaying it in your rent. Everybody talks about, well, I can pay rent. My rent is double what I can afford a house for, but the bank won't give me a loan, right?
Mm.
And everybody complains about that today.
Yeah.
Well, because your credit sucks, probably. Right?
Yeah.
You shouldn't, because lenders are not, the mortgage people, the banks,
Mm-hmm.
they're not landlords.
Yeah.
They don't want to own a house and charge you rent.
Yeah.
That's why they don't give you the mortgage.
Mm.
But a landlord, he's used to finding tenants.
Yeah.
A bank won't. A bank doesn't know how to find tenants. So they're not in the tenant business.
Yeah.
That's why it's 2 different prices. But it's the same costs.
Mm.
It's just rent, you pay for it up front. And yeah, the owner of the property is making money. But guess what? If you only live there for 1 year, right, he might make 20% profit after property management fees, and if nothing happens during that year,
Yeah.
20%. And guess what? Then you leave after a year, and it takes him 30 days to find someone else.
Yeah.
He just lost 1 month's worth of revenue.
Yeah. Which is huge.
Right.
Yeah.
Yeah, it's what, 8.33%,
Yeah.
right, of that's coming in. And then guess what? He probably had to clean it,
Mm.
maybe do some updates to it.
Mm.
So he can take all of that profit from the prior year and stick it right back into the property and earn 0%.
Yeah.
A single family home.
Yeah.
Right?
That's a really interesting point because now looking at it from the landlord's perspective, maybe hopping right back into the investment side of things. You're a landlord, or maybe we'll take this from the perspective of you are considering becoming a landlord.
Yeah.
And you're weighing the advantages and disadvantages to flipping over doing that.
Right.
Do you have a perspective on that as well?
Yeah.
Like when
if you're gonna buy single family homes, I'd rather flip them than rent them. The thing is, you have to look at on the single family rental side is I can rent it, but if everybody in a good school district,
yeah,
and the people that I rent it to better have kids,
yeah,
because they'll want more stability.
Yeah,
right. Then you get a longer term tenant. The longer term tenant equals into more profitability. Right.
Right.
So those are the things that you can look at, but investment wise, there's so many different factors out there. You can just have bad luck with tenants, bad luck with a property, right? After you buy a property, you can be like, oh, I just put 10 grand into it because this or that needed to be updated. Yeah.
Oh, you miss things with the inspection, or it's just something unexpected happens. Absolutely.
Right.
Absolutely. And when it comes to the actual appreciation of value in the houses, is there some sort of is there anything you consider when it comes to timing the market, or when you want to get into the market, or when it comes to evaluating? This is we're getting really deep into real estate, which is not in the weeds, but I think it's very interesting, especially since you're probably coming across a lot of people that are affiliated with this. Would you try? Have you ever in your past tried to time markets when it comes to investing in a property or anything like that?
Yeah. Well, so for your primary residence, people have timed markets and tried to.
Yeah.
It's hard.
Yeah. Right.
Because you don't know when the bubble's going to burst, or when it's going to go back down, or when there's not going to be a free flow of cash to borrow against to actually buy the houses that we're buying today.
Yeah. Do you think it's better to try and time it with the? And I guess this isn't something to add. Let's say you're not trying to time it with the appreciation of the market as a whole, but you're trying to time it with interest rates, or maybe the government policies instead. Or even when it comes to playing the do I refinance or not refinance game, how much should you consider? Because
So the first part is not timing it. Remember, what is your house? It's a place to sleep indoors.
Okay, I thought I was a useless employee.
It is. Same thing, right?
Right.
It's just to sleep indoors.
Yeah.
Your lifestyle, it's a lifestyle expense.
Yeah.
Look, if you want a nice lifestyle and can afford a nice lifestyle, albeit go for the nice house, get the payment. But guess what? With today's interest rates and the length of time, everybody's looking to pay off their house early.
Yeah.
Why would you pay your house off early and give the bank back that cheap money earlier?
Yeah.
So I talk to people about this all the time. So your savings account, how much is it earning? Like 0.00 nothing.
Yeah.
Right? And how much are you if you gave the bank $100,000 to put in your savings account, and they're going to give you 0.5% because they're nice that day, right?
Right.
And you went the next day and say, hey, I need to get a loan for $75,000. What interest rate would they charge you?
Oh, wow.
Like 5% if you're good.
Yeah.
Right?
Yeah.
So they're lending you your money back for 10 times the amount that they're paying you on it. Right?
Right.
Now, right now, interest rates are cheap, right? I can go buy a $400,000 house at 3% rate of interest rate.
Yeah.
Right?
Crazy.
And I get the longest term possible.
Mm-hmm.
Because I want to make those bankers cry in 15 years when they're like, wow, that Rob guy, he's only paying us 3%.
Yeah.
We need to send him some notices to get him to refinance.
Mm-hmm.
And guess what? Interest rates are what? 7%.
Yep.
So who's buying a 7% bond?
Oh.
Everybody is, right?
Yeah, they love that.
Who's buying a 3% bond?
No.
Nobody.
Yeah.
Right? It's too cheap.
Yep.
Why would I buy a 3% when I get a 7%?
Right.
So no one wants my money.
Mm-hmm.
Right?
Right.
Because it's too cheap.
Yeah.
Which hurts who? The bank. Because every payment I send into them, guess what they're doing with it?
Reinvesting it.
Yeah, they send it back out at 7%.
Right.
And they're like, hey, no, you should double up on your payments.
Yeah.
So I can double up on my interest.
Yeah.
So why pay off a loan early that's guaranteed and locked in for 30 years?
Yeah.
When I can put that into my investment account or whatever account and make 5%.
Yeah.
Right.
And do you ever, and even talk with people about, let's say they have a lot of debt, but we're in this high inflationary event, or not event, in this high inflationary environment, and these people with these large debts, and you're talking about saving and paying off the debts at the same time. Is there some sort of consideration as well with how does my return on my investment compare to the appreciation of my debt or depreciation of my debt with inflation? And a lot of people might not consider that when it comes to bigger purchases. Is that even something that is worth considering, or is it actually more relevant to consider it with smaller investments?
So I think the first question was like that debt part of it, right?
Right.
So pay off your high interest debt. If you're making 18% of your investments and you're paying 18% of your debt, it's kind of a wash.
Yeah.
Right?
Right. So you want to get rid of, so you actually want to just actually prioritize that debt by the interest.
Still save something because you have to figure out why you got to the debt, right?
Right.
But on the second part, what was the second part again?
Well, the second part was when how does the size of the purchase factor into that equation? Yeah.
So the size of it. So you're always looking at how much money is the official outlay of it, right?
Right.
How much money are you giving up?
Yeah.
In the way of future income.
Right.
Right. The liability. If I'm buying this debt, $400,000, I know I just sacrificed $400,000 of my future income to pay for that.
Right.
As long as it's not an asset as well, like a home.
Yeah.
Right? I think that was the question.
Yeah.
Maybe.
Yeah, it was. No, it was good. I guess I just want to revisit the retirement thing, because we haven't actually touched on annuities at all.
Right.
And annuities are, there's probably so many people that are watching this right now. They hear the word annuity,
they freak out, right?
Yeah, or they have absolutely no clue what that
that's
is.
True.
They might think it's a town fair. Can you maybe break down an annuity? Or
so an annuity is an insurance contract.
Okay.
So you're investing in the insurance company, right? There's 3 different types of annuities out there. There's fixed annuities, which are practically like a CD. You invest your money into it. You give your money to an insurance company. The insurance company says, "Great, for 10 years, I'll guarantee you 2.5%." And you never make more than that, but you never make less than that. It's compounding, and then at the end of the time period, you get your money back.
Okay.
Plus your interest earned.
Yeah. Right.
Sometimes you can tap into it, but very little per year.
Okay.
There's fixed indexed annuities, which are similar to like that PLI, where it's you say, "I'm going to give you money, and then I want whatever that account or that index does. Say it's an S&P 500 index.
Yeah.
Whatever that index does, credit my account 80% of that. Okay. When the market's up, so the S&P 500 went up 30% this year, whatever it was, right?
Yeah.
Right. So if I got 80% of that, they would credit my account 24%.
Right.
Right. Now the next year, we know like 2022, if my account renews on the annual basis, and next year it drops, and it goes down by 30%.
Yeah.
Well, my account in that fixed index annuity will give me 0% rate of return, so I don't take the loss. I just take the upside.
Yeah.
And my account still earned 24% the previous year, so it already leveled up.
Yeah.
Instead of 100,000, it's at 124, and at the end of the second year, it's at 124 again, because I got a 0% rate of return because the market went down.
Yeah.
It does that every year, right?
Right.
But you're giving up part of your interest that you could be receiving as insurance for no downside risk. So a lot of retirees like it because it's in that safe bucket of money, right? You don't lose your principal.
Right.
Right? You can only get upside to it.
And is putting money in these different vehicles also have tax advantages to them?
Yeah, so annuities are tax deferred.
Okay.
So it's just like your 401k account.
Okay.
Just the earnings on it is tax deferred against capital gains tax.
Okay. Yeah.
So that's the only problem with those accounts is you're pushing it off later on, but you never pay tax on the actual asset if it was used with after tax money.
Okay.
Then there's variable annuities. Those are actually in the market. Like you buy mutual fund sub accounts with those.
On the separate account.
Yeah, separate. Yeah. So you're investing in mutual funds in those, and you ride the whole entire thing up and down. Okay. The whole idea of an annuity is you want growth out of it, but at some point in time you want to turn that asset into income.
Yeah.
Right. So the insurance company knows how long you possibly going to live. They'll say, "Hey, you're 65. The likelihood of you, if you're married at 65, there you have a 75% chance of one of you guys living till age 93.
Oh, wow.
Yeah, it's a long time, right?
Yeah, it's a really long time.
So the insurance company does all these calculations to say, hey, if you give us $500,000 at 65, we'll guarantee payments to you for the rest of your life at $3,000 a month, forever.
Yeah.
Even after the tank is empty and there's no cash in there, the insurance company keeps paying you.
Yeah.
Right?
Right.
Because it doesn't matter how much in assets we have in retirement. It matters of not running out of income.
Yeah.
So I call it paychecks, right?
Mm-hmm.
So in retirement, I just want a paycheck that arrives every month that I can spend. I don't have to save because I'm done.
Yeah.
Right? I just want a paycheck.
Yeah.
And guess what? At the end of every month, guess what happens? Boom, repopulates again.
Yeah.
So those are what annuities do. Like a pension is an annuity. They're kind of depleting. There's not a lot of those around anymore.
Yeah.
Social Security is similar to an annuity.
Yeah.
Right?
Do you
pay premiums in, you get payments out.
Yeah. Do you see this as an important vehicle for people, especially as we enter this growing generation that's going to be retiring soon?
Yeah. So I'm using a lot of these products right now with a lot of my pre-retirees and retirees. So I use a lot of those fixed index annuities for protecting their assets. Mm-hmm. So I protect those assets as they start rolling into retirement. It's not going to go down in value. It's just going to go up. So maybe they're 60 years old and they're retiring 5 years. Great, let's put 30% of your assets over here.
Yeah.
Right? Protect it because we're going to need that in the following 10 years.
Yeah.
And if the market crashes like it did in 2008, we've got less money to work on.
Yeah.
And that means your lifestyle's going to be less. Mm-hmm. That means you worked your entire 40-year career to have a lower lifestyle than you did while you're working.
Yep.
Is that what you want?
No.
No, so we want to hire. So we use different types of vehicles to kind of figure out what the plan's going to be like.
Yeah, and that's probably so, especially during this time period when bonds and a lot of these, safe passive income equities that you would want to buy are just so, they're so discouraging when you look at them. That's why it's increasing option trading and stuff, and why people are getting so far out on that risk curve on the tail end of that.
Yeah, and so many clients are. Like a lot of people are getting out of the bonds and getting into the more of the equities.
Yeah.
And so what a lot of my clients will do, they'll either go very risk adverse and just be like, I just want the fixed income or the government bonds or whatever, right?
Yeah.
At 1%, 1.5%, right?
All right.
Well, we just talked about inflation earlier.
Yeah.
Right? You're actually losing money.
Yeah, it's negative.
So a lot of these other products, the fixed index annuities, will take that, and I'm like, do you want something that's going to grow 5 to 7%?
Yeah.
With no risk? Yeah. So they move a lot of their money over to that, and that's like their bond portfolio now.
Yeah.
Because it's safe, secure, and it's earning more.
Yeah.
It's actually keeping up with inflation.
Is there any chance or situations where a company would want to? Do you have group annuities or group life insurance opportunities as well? Is there would a bank have a life insurance contract?
Yeah, well, banks are big believers in life insurance.
Really? Okay.
Yep. So they have bank-owned life insurance or commercial-owned life insurance.
Yeah.
That's actually like a tier 1, an A+ asset inside of their portfolio. They own lots of it. They own a lot of it.
And do they basically do the same thing that you've advocate for the individual to do, where they kind of, I guess, the bank acts as its own bank with its life insurance. You can borrow against that, just like the individual could.
Yep.
That's
it's their tier 1 asset that they have on their balance sheet. If you look it up, bank-owned life insurance, like they have $18 billion. They have lots of money in life insurance cash value that they've built up. A lot of companies are using it for bonus programs. It's like a deferred compensation plan for their high wage earners.
Okay.
So they would give them, they'd say, hey, we're not going to pay you cash. It's going to be added onto your income, but we're going to put $100,000 a year into this life insurance contract. So when you parachute out 10 years, 15 years from now, you can take that contract.
Oh, okay.
So Jim Harbaugh, the coach for the Michigan Wolverines, that's how they pay him part of his salary is in an index universal life contract.
Oh, wow, okay.
Yep, they pay him a lot of money every year that goes into that, and that's what we put into there because it's growing tax deferred, and he has access to it tax free.
Yeah. That's nice. That's really nice, especially when you're making so much money and you're in such a high tax bracket.
Right.
And then when you're only leaving money to your kids, if that's not tied up in something that's tax advantaged, that money's going to the government, not going to your family, which is really concerning for a lot of people. I think that covers a lot of those. I also wanted to just take a moment, just kind of wrapping up, like with CWR Private Client Group. What are your long-term goals for this company, especially as we, and I think if people are probably watching this, have probably heard some bits and pieces of that in the Discord, especially the conversation around that. But what is, and I'm not talking about like the next year, but 10 years from now,
right?
What does that look like?
Yeah, so that's a great question. So I look at CWR as an out of the box, out of the normal realm thinker when it comes to helping people with their financial situation.
Yeah.
Right? And I want to continue that journey because I think there's more value in that than by just selling someone a stock, bond, mutual fund.
Yeah.
Right? Like most of the other financial firms out there are just selling products. Well, some of my clients, they don't even want mutual funds. They're business owners. Yeah. They're like, I'd rather invest in my own business. So when I look at the firm here, it's we want to think outside the box. And I want to grow this firm so that we have more people that think outside the box, not just here in the Missouri area, but across the country.
Yeah.
So 10 years from now, I expect to have other offices, other locations that would be helping those individuals in those states.
Yeah.
And that's where I look at it. So, actually, one of the things I just was writing up the other week is adding more people to the firm by the end of this year, 2 more people.
Yeah.
So I'm actively looking for people that want to get into this business and not just do what everybody else is doing.
Right.
Because that's boring.
Right. So he's looking to add people to the business.
Yeah.
So for something to consider. So that's awesome. And what was the catalyst for getting to that out of the box thinking? This is not anything anyone's going to pick up, even if they go on YouTube and they're looking to learn about finance. These aren't even different things that you will find if you search for that. This isn't like a top Google search. You know? These are very, I don't want to call them obscure, but they're just not as well published alternatives that people can use.
Right.
What drove you to these? What was the discovery of this?
So it's funny. So I've been learning about, I started back in the financial services industry 20 plus years ago, and I didn't know about all these other things.
Yeah.
It took me a while to even understand permanent life insurance.
Yeah.
Right? But then I still didn't understand it.
Yeah.
Right? I was like, okay, it's out there. But I thought the same thing that most people think, it's a scam, it doesn't work, it's whatever. But it was just in the place that I was in, didn't have the right products. Right? So when it comes down to how I started learning. I've probably spent more in my education learning about this than most people pay for a college degree.
Wow.
But I paid cash to other people, mentors, training, conferences, seminars all over the place.
Yeah.
So, I mean, that's January. I was just at a conference last week down in Florida. Go to one later this week in Arizona. Have another one in Texas next week.
Yeah.
So it's always learning about the new opportunities that are out there.
Yeah. Yeah.
Not just the normal things that people talk about.
Yeah. And I mean, generally, that's like the key thing to being for most entrepreneurs, a lifetime of learning. And I guess there's great input. It's really interesting. And I guess let's go ahead and wrap up. I'm going to take a page out of Lex Friedman, who's a popular podcaster. He likes to end every podcast with asking the person who's on there with them, what would be your one piece of advice that you would like to give to young men and women that are, let's say, leaving high school, entering college? What would be the one piece of advice you would like to emphasize to help them as they lead through that transition into maybe what their passion is, or pursuing their own business, or maybe they don't want to go to college and they just heard you mention going to seminars and doing that and getting that really specific training that so that when they're done learning, they can actually immediately get a job and not just go to another training seminar.
Right.
So what would can you try to boil that down, or maybe just reiterate a point you made?
So don't get a bunch of education to go find a job.
Yeah.
Right?
Yeah.
So most people are concerned with their job. Right?
Yeah.
I might lose my job. I might not get paid enough. Like, there's people out there complaining about not getting paid enough in their job.
Yeah.
Well, no one's going to work at minimum wage. Well, no one's asking you. Just accept it, right?
Right.
So don't be a worker. Right? There has to be workers out there. But go do something for you that you're in control of.
Yeah.
I tell people this all the time. If you're young, go find something that you can be in control of.
Yeah.
That you can do, that you can own, that you can start, that you have the freedom that you want to have.
Yeah.
Like, go back to like the whole renting thing, home ownership versus renting.
Yeah.
What if you start an opportunity business that leads you to Florida or California? Well, if you own a house, you got to sell that darn thing.
Yeah.
Right?
Right.
But to tell you the truth, I look at all these people living in vans. In fact, one of the guys that I just met down in Florida, he bought one of those Sprinter vans, got it all decked out. He still has a house, right?
Right.
But he drove from Vermont all the way down to Orlando.
That's awesome.
And he's like, it took me like 3 weeks to get down here.
Wow.
But in today's world where everything's electronic, Zoom calls, everything like that, or just being able to go someplace, right?
Right.
Having the freedom to do whatever you want. Well, I'm going to go sit by the beach tonight.
Yeah.
So that's, if you're young, you need to follow your dream, follow your passion. It's not easily accessible right away.
Right.
But go out and do things. Go out and learn.
Right.
Go out and do different activities. Even if it's for like 3 months. I don't like that. I'm out.
Yep.
But don't pay a bunch of money to go to college to figure out you don't like what you're going to college for.
Right.
Right? Go work at companies. Go intern. Figure out where your passion is, and then immediately drive to do that full time by yourself.
Okay.
Or start the side hustle.
Right.
A side hustle that's going to cost $100 to get started. Whatever.
Yeah.
Just go do it.
Yeah.
Why are you sleeping? You shouldn't be. You're young. Right?
Right.
You have no responsibilities.
Yeah. Right.
No responsibilities. Live as cheaply as possible.
Mm-hmm.
Even when you get older, it's about freedom, right?
Right.
The bigger your lifestyle is, the more you have to go make.
Right.
And then the less your lifestyle becomes.
And then the less you probably want to constantly focus on retirement.
Right.
Because usually when I do hear these people that are obsessed with, I want to retire as soon as possible, is they hate their jobs.
Right. That's why they want to retire as soon as possible.
Right. Yeah.
I love what I do. Will I ever retire? No.
Yeah.
But why would I own my own business?
Yeah. 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 I mean, so it's your passion, so maybe you don't ever want to quit doing that. 'Cause
right.
It's not work at that point.
Right.
You just.
Yeah. But go after your passion and do your own thing.
Right.
I think the world of a W-2 employee is going down the drain.
Yeah.
And we're seeing that right now. with the labor shortages.
Yeah.
People are doing their own little side hustle.
Yep. I mean, they have to. Wages are not increasing either, so it's a big.
So go do your own, see what it's like. People charge $150 an hour to do consulting. And they're like, oh, that's a lot. And it's like, well, no, that's what it costs to have health insurance, to do all these other things, just to make $30 or $40 at the end of the day. Taxes, everything else.
Yeah. Yeah, it's so hard to get people to understand that aspect of it.
But the business part of it, that's why I think outside the box. Like, a lot of things I tell people to do, I'm like, you're not even going to do it through me. You're going to go over here and do that. You're going to go do that. Whatever.
Yeah.
I'll point you in the right direction.
Right.
But that's why, that's what sets us apart from everybody else. You go to a regular financial services guy,
and they would be
or gal,
end all be all.
Well, they're saying, well, you should, whatever your situation is, buy a stock bond, mutual fund.
Oh yeah, that's true. Yeah, right? That's actually a one size fits all.
It's that's what they're doing.
Yeah.
Well, if you're gonna come to me, I'm gonna be like, well, let's look at what you want to do.
Yeah, it's a one size fits one.
Yeah. And be like, okay, well, based on what you want to do, these are the things that I would set up.
Yeah.
Go.
Awesome.
Right.
Well, that's awesome. Well, thanks for coming on the podcast.
Thanks for having me.
Yeah, absolutely. We'll go ahead and call it there. And thanks for watching, everyone.